Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. And just ahead on the program, a look ahead to the June jobs report in the U.S. and what it means for the Fed's monetary policy going forward. I'm John Tucker in New York.
I'm Caroline Hepker in London, where we're looking ahead to what is expected to be a landmark election in the UK.
I'm Brian Curtis in Hong Kong. We look ahead to the 27th anniversary of the handover of Hong Kong to China. What's changed and where are we going?
That's all straight ahead on Bloomberg Daybreak Weekend on Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 106.1 Boston, Bloomberg 960 San Francisco, DAB Digital Radio London, Sirius XM 119, and around the world on BloombergRadio.com and via the Bloomberg Business app.
Hi, everybody. I'm John Tucker, and we begin today's program with a look ahead to the June jobs report in the U.S. That date is going to be released next Friday at 8:30 a.m. Wall Street time. For more, we're joined by our Economic Roundtable. Let's bring in Michael McKee, Bloomberg International Economics and Policy Correspondent, and Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. So the next big data point, the payrolls, that's the other side of the Fed's policy mandate, because we already heard about inflation. So correct me if I'm wrong, guys. Inflation, the rate of inflation headed in the right direction. So what are we expecting from the jobs market, Mike McKee? We'll start with you.
Well, we basically look at the jobs market as unchanged, or at least when I say we, I mean the consensus of economists surveyed by Bloomberg, as they like us to say. 188,000 is the forecast, which is roughly what the forecast was last month. Of course, we got a big surprise, came in at 272,000. Economists expect hiring to slow, but until it does, they're reluctant to predict it. So they still see essentially where we are is where we are.
All right, so Ira, what does a slowing jobs market mean for rates?
Just like it has been over the last couple of weeks when we've gotten the better inflation data, it probably means that that interest rates will continue to slowly come down, and eventually, once the Federal Reserve starts to actually cut interest rates, some of that rally in the Treasury market, so that means prices higher, yields lower, that it can accelerate a little bit, particularly in some of those shorter term maturities like 2-year Treasuries and 3-year Treasuries. So this Friday's data is going to be pretty important, from the overall kind of mosaic of the economic landscape. But I think what's really interesting about it is the fact that it's on a Friday in between the 4th of July and a weekend. So
I know I'm not going to be here. But you guys will be
around. Yeah. So I think one of the questions is how well staffed will trading desks be? So if we do get a number that's significantly away from consensus, like a big number like we had last month, or a much lower number, will we see additional volatility than you might expect otherwise? And I do suspect that we could wind up seeing like a crazy knee-jerk reaction one way or the other. Maybe over time that gets kind of taken back. But I suspect that there is the potential for very high volatility, not only in rates markets, but in just about every market around the world.
Will you guys explain to me, what's the dividing line here? At some point, a slowing economy, that's not great for company profits.
It depends on how companies manage their margins. What we're seeing in some cases is the slowdown may be affecting hiring. In other words, people not adding as many jobs. That's what's being expected. Of course, I just told you that we probably did. But we're expecting fewer people being hired, and jobless claims have gone up a little bit. So if the economy slows some, but you're cutting some of your expenses, and we saw in earnings reports in the first quarter that companies are looking for a lot of ways to manage their expenses, then margins can stay higher and profits can be still strong. So it's kind of hard to say at this point it's going to really hurt the investor going forward. When the Fed starts cutting rates, it should help investors.
Okay, so it's political season, the silly season. So what does this mean for politics? And Ira, you're going to put on your politics hat right now and answer that question for me. Is it good for the administration, the current administration?
Well, no, it's a slowing economy, I think in general would be bad for the current administration and the current party that's in power and incumbents in general. We have seen that
But
trend
it means
over
that
time.
rates are coming down and lower rate of inflation and lower rates. That's good.
Yeah, keep in mind, we've all been around for a very long time. So for those people who are, newer to the markets or meaningfully younger than us, I recall during the 1992 presidential election, George Bush kept on saying, "Oh, the economy's improving," which was true if you looked at the GDP data and industrial production and even the job market. But people didn't feel that way, and because people didn't feel that way, you wound up with George Bush losing to Bill Clinton, right? And something that was crazy after the Gulf War, given how popular George Bush was just a year before. So I suspect that part of what we look at with some of the data that we received, just this past week, we got the Michigan consumer confidence data that actually popped up a bit, but is still showing that people are less confident than they were, in 2021. So, and a big part of that, I think, is still this overhang of how high inflation was and the idea that we have politics being so poor, I think is reflective in a lot of the survey data, even though some of the, hard data, while it's slowing, is still pretty good, right? 188,000 jobs, if that were to be the steady state pace of the job market, would be fine. Yeah, that would be absolutely fine.
Mike McKee, does the tone of the Fed, I feel, doesn't match the data that I've seen. Am I crazy?
No, I mean, it depends on the data you're referring to. The tone of the Fed basically has been, looks all good, but let's make sure that it doesn't reverse. And so we're waiting for additional data to come in. But remember, they're also talking to CEOs and small business owners all the time. And they have a pretty good read on what the businesses in their districts are thinking they're going to do in terms of hiring, in terms of business, in terms of pricing. So they've got both sides of it covered there. And once they are a little more certain, which would probably be in another month or so, then they probably will look to cut interest rates, and you'll hear much more unanimity on that idea. Problem is, it takes a while. We have lags for rates to have an impact. In most cases, they would have more immediate impact on Wall Street, which exists to react. But for the American people, it's going to take a while before they really see lower mortgage rates or lower auto loan rates. So it would take a while to sink in. That's a little bit of a way around the answer, an answer to what you were asking about politics. Probably even if the Fed cut in September, people wouldn't be putting a lot on that by Election Day.
Okay, I'll focus a little more on the mandate that Congress usually follows, but deficits, Ira Jersey. Can we focus on that? Because they do matter, and I don't hear too much rhetoric from the candidates on this front. When the government's competing for capital because it has high deficits, it takes away from the capital available for investment. That essentially drives up rates. Do I have that right?
Generally speaking, yeah, additional supply should mean that rates would be higher than they would be otherwise. But the Treasury market is still the safest, most liquid market in the world. So, and is much more sensitive and remains much more sensitive to expectations for the Fed. So yes, so instead of maybe say a 1% decline in interest rates, if the Federal Reserve were to cut, maybe you only get like 0.95 basis points, right? You get 95 basis points instead of 100 basis points in terms of a rally in the rate market. So it's still what the Fed does matters the most for returns for Treasury investors. As far as deficits go, one of the issues right now, and to your point, is neither party seems very focused on being fiscally prudent and fiscally responsible. So there's not a lot of gain to be made politically in order to say, hey, we're going to cut the deficit by increasing taxes and cutting spending, right? Like neither party wants to do
You're not going to
get
any political points for being responsible.
Yeah.
Right.
John's learned the first rule of politics.
Okay, Mike McKee, I'm going to throw this one at you. The Fed's balance sheet, and Don't tune out, anybody, because this is not boring. The balance sheet, there's a contraction from the Fed's balance sheet. And the reason this matters is because they were spending a lot to stimulate the economy. Slowly, that's contracting. So what's that going to mean for assets like my stock portfolio if that's contracting and there's no longer stimulus there?
Well, it shouldn't mean anything, and so far hasn't meant anything. The Fed has figured out that QT, as people like to call it, it doesn't work the same way as QE, because when the Fed starts stimulating the economy by buying assets, the markets price in the idea that assets are going to go down eventually because it has to end. And so the QT process becomes an accepted part of the cycle, and it doesn't really move the market, move yields in the same way that it does on the way up. So the Fed's argument and the research has shown that you don't get much of a change because of QT. You can have a problem in the money markets if there is a shortage because the Fed is taking securities out of the market. There's a shortage of stuff to repo, and we had that problem in 2019. Fed officials argue now that won't happen because, A, there's a lot of money in the reverse repo facility that can come back into the repo market, and there's also the Fed's standing repo facility where if you need cash, you can give the Fed securities and they'll give you cash. So they shouldn't see the 2019 issue arise again, but they're still going to be careful, which is one reason they're tapered the amount that they're running off each month.
Ira Jersey, our rate strategist, I'm looking at my screen. There's this inversion between rates, the 2-year and 10-year. We'll take that. The 2-year is higher than the 10-year. That's what we call the inversion. That's usually been a predictor, at least in the past anyway, of recessions. It's been that way for a long time. We haven't had a recession. Can you give me a reason why?
Yeah, well, the market got it wrong. The market had been pricing for a recession for the better part of a year, and that we never actually got the recession. All that an inverted yield curve says is that the market believes that interest rates are going to be lower in the future than they are today. Now, why is that? Probably because of a recession. We don't have one, and so the market has to keep on kind of pushing that out and pushing that out and pushing that out until we actually see the recession and the Fed actually begin cutting interest rates.
That's a good explanation. Again, the next big data point, payrolls, the other side of the Fed's policy mandate. All right, thanks to Michael McKee, Bloomberg International Economics and Policy Correspondent, and Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. And just ahead on Bloomberg Daybreak Weekend, we're going to look ahead to what's expected to be a landmark election in the UK. I'm John Tucker, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm John Tucker in New York. Up later in the program, we're going to look ahead to the anniversary of Hong Kong's handover to China and examine its current relationship with China. But first, voters in the UK will go to the polls on Thursday to choose the next government. The opposition Labour Party has had a massive lead in the polls for many months, while the ruling Conservative Party could be on track for an electoral wipeout. Regardless of who wins, the next government will face major economic challenges and fiscal constraints. And for more, let's go to London and bring in Bloomberg Daybreak Europe anchor Caroline Hepker.
John, the UK has had 5 prime ministers in the past 8 years, and it looks likely it will be getting a 6th in the coming days. According to Bloomberg's poll of polls, the Labour Party has had a 20-point lead over the Conservatives for months now, and the election campaign hasn't done much to shift that advantage. Labour hasn't been in power in the UK since 2010, and some projections see a victory akin to that of Tony Blair's landslide election win in 1997. But the economic context this time is very different. Fiscal space is in short supply, and fears of a repeat of the market mayhem that engulfed the UK in 2022 under the then Prime Minister Liz Truss will prevent any big borrowing binge. Now, both the two main political parties claim that they are the party of business. And that was a key battleground when the Business Secretary Kemi Badenoch from the Conservative Party and her Labour counterpart Jonathan Reynolds took part in our special Bloomberg debate just in the last few days.
The Labour manifesto, the Labour agenda, is what we call a pro-worker, pro-business agenda, and the agenda reflects that in its aggregate and total form. It's everything from a better business environment around changes to planning, to tax certainty, to how things like the skills system works. But we want that to deliver growth that every part of the UK and every person within it benefits from. And the employment framework the floor will rise, but frankly, the vast majority of businesses operating in the UK are operating to a higher standard than those sets of proposals. It, I think, provides what I would call a flexibility that works both ways. So it doesn't take away some of the advantages of our labour market, but it delivers in a way which isn't one-sided. And it gives people the chance to feel and participate in the economy, to have the benefits for themselves and their family that they're seeking. And it's been developed very closely with businesses to make sure those burdens are not too burdensome.
Kemi Badenoch, developed closely with business. Why has the Conservative Party not tried to introduce those kinds of measures?
Because business doesn't want them. I think it is unbelievable that Jonathan would actually suggest that those employment regulations have been developed with business. Which business? Business is terrified of what Labour is selling. And one of the things that's really interesting is to listen to how Labour talks. He's talking about Rishi Sunak being dishonest. He's talking about Liz Truss. This is very personal. They have no diagnosis of the fundamental problems of this country. All they can see is the individuals in the government. There is no, and if you do not have a good diagnosis, you have no solutions. I would ask him what he thinks business thinks of the new employment regulations that are going to make it very hard to hire, strangling employment right at birth, the day one rights that they're bringing in. Businesses, CEO of Asda, Currys, M&S have said that these are terrible regulations. Which businesses have they developed them with? They are bad ideas.
Well, I strongly push back on that. And I would just remind you, Kemi, when the Conservative Party led this country out of the European Union, you promised an employment bill. You promised many of the things that are in this package. You didn't deliver on them. That's one of the reasons you've lost so much support. You promised people security in the workplace. They haven't had that. And I don't think anyone could look at the set of proposals being put forward by the Labour Party and say they are unreasonable. And the idea, by the way, there's some sort of continental labour market. These are specific things for the UK that will give people the chance to participate and feel a part and feel the benefits of a stronger economy, which in a way is still, without any question, a better business environment to operate in, and which, frankly, give people the kind of security, the kind of work you can raise and build your family around that everyone should be supporting in the UK.
You should be terrified about surrendering your business, the economy, tax to Labour. Absolutely terrified. And the reason why I say that is because the problems in our economy are not to do with flexible working rights. We have some of the most flexible working rights in the world. That is a problem that is solved. We've brought in all sorts of things, working from home, bereavement leave, parental leave, shared parental leave. We have done a lot. The fact that they are fishing in this empty barrel for solutions shows that Labour have no idea what this economy needs.
That was Kemi Badenoch, the current business secretary there, speaking to our colleague Anna Edwards in the TV and radio debate that took place at Bloomberg's European headquarters. So that gives you a flavour of how the two main parties are thinking about this campaign. Investors, interestingly, don't seem too worried about the risk of volatility from this election, partly down to the cautious policy proposals of the Labour Party and the Conservatives and the limited room for really big spending plans. Here's the view of Henrietta Packmar, who is head of global fixed income at Allspring Global Investments, on that point.
So the UK government is likely to have issues, yes, absolutely. They're going to have to make some tough choices in terms of what they choose to fund and how they choose to fund it. So the markets are going to be watching them like hawks, and the long end is going to be the more volatile area there. So really interesting to see how they react. Do we get the same volatility as we had in the Truss sort of moment in 22? I do think one difference compared to that time is the technical environment is a little different given what we lived through in that period. So some of the leverage in the system isn't going to be quite as acute. That being said, I do think that the markets, and it's not just the UK, are going to look to keep a lid on spending generally at a sovereign basis.
At the short end of the gilt curve, how many BOE cuts are you expecting this year?
Our call has been that the BOE would come after the ECBs. So at this point, probably a couple of cuts from the UK.
Starting in August?
possibly in August, depending on the data that we get between now and then. We think that probably makes sense given the sort of inflation progress that the UK has made so far and the sort of growth prospects as well.
That was Henrietta Packamar from Allspring Global Investments speaking to Bloomberg's Lizzie Burden. The economic outlook for the UK is improving. Inflation hit the Bank of England's target of 2% in the recent print. Bloomberg Economics is also expecting 2 interest rate cuts from the Bank of England this year and growth for 2024 of 0.8%. That would actually be an improvement on 2023. Business groups want the next government to tackle some of the longer-term issues facing the UK economy. Martha Lane Fox, president of the British Chambers of Commerce, told us recently of the massive skills shortage that is holding back growth for many businesses.
We're not going to be able to make our businesses more competitive globally, but also just grow the economy, as every single politician has said ad nauseum in the last few weeks, if we don't make sure we've got the right talent to do it. And it's depressing that nearly 3/4 of our businesses are feeling anxious about skills in their business. And crucially, in my opinion, feeling anxious about 2 enormously important areas of skills development over the next decade: AI, digitization, and the green economy, where we're going to need people if we're going to build a modern, robust economy for 2030, 2040.
What is the message to the next government then in terms of laying the groundwork for skills from here?
Well, I think the first thing is to really recognise the issue. And when I first became president of the BCC 18 months ago, I come from the technology sector predominantly. I'm used to never having enough skills because you're always inventing stuff. You don't really have the right people. But I was so shocked by the skills issues across every sector, every bit of the country that I went to, whether it was hospitality, whether it was social care, whether it was advanced manufacturing, defence, whatever the area I was lucky enough to be understanding. So I think there are some things that are working. And one of the things that we run at the British Chambers are the local skills improvement plans. We run them on behalf of the government. They're great. They are a framework for businesses to sit down with a local set of both skills providers, universities, schools, other people that can help solve the issue, to map out what the local businesses need and what the local area can try and build capacity. And so there are things that work, and we really hope that any future government pays attention to that. We did a report called The Future of the Economy, and we looked particularly at people at work. There are loads and loads of policy ideas in there. So there's no shortage of ideas, but it's also about businesses themselves. Having faced such tough economic headwinds in the last few years, unfortunately, skills training budgets do get put down the list and deprioritised. And so we know that there's just been far less investment.
That was Martha Lane Fox of the British Chambers of Commerce speaking to Bloomberg's Anna Edwards. Well, another factor which is contributing to the UK's labour shortage is the number of people who have dropped out of the workforce. We've been discussing that with Rahul Ruparal, who is the director of BCG's Centre for Growth and also a former advisor to the former Prime Minister Theresa May. The consulting firm has just published a report on the problems of economic inactivity.
The key challenge that needs to be tackled that we've identified is this rise in long-term sick people out of the workforce. So since before COVID, we've seen a rise of around 750,000 people who are long-term sick and out of the workforce. And that is a significant rise and makes the UK an outlier compared to its peers. So the UK's economic inactivity has risen by over a percentage point, whereas most EU countries have seen it fall by over 2 percentage points. So we're really on a completely different trend to everyone else. And I think the impact of this is significant. We looked at the potential size of the prize in terms of both economic and fiscal gains if you reverse some of this rise. And it could free up over the next 5 years, over the course of the next parliament, between 35 billion and 57 billion in fiscal funds by reducing the number of benefits payments and improving the tax take. And it could also boost GDP by up to 3% over 5 years. So these are really big numbers and show that tackling some of these complex health challenges and complex economic challenges is actually the best way to look at generating growth and fiscal revenue compared to some of the tinkering we've seen debated in recent weeks.
Do you get the sense that the big parties are really taking this issue seriously?
Yeah, look, I do think it is an issue that they take seriously for a couple of reasons. One is obviously the significant fiscal costs that I've outlined. And I think, in a very fiscally constrained environment, freeing up 30 to 50 billion over 5 years is a significant amount and something that both parties take seriously. And we've heard talks about the benefits bill, etc., during the course of this election. But I think they've often talked about the wrong thing and not looked at the fundamental drivers as we are here. And then the second reason is, we have still very low unemployment, very high employment, and a very tight labour market. Having a very tight labour market and this number of people out of the workforce is going to have a long-term effect on the supply potential of our economy and effect on growth. So for both those reasons, and then we also add in the fact that we have, this has an effect on people's health outcomes and people being sicker. So three really big reasons there why I think both parties are aware of this issue.
That was BCG's Raul Ruparal speaking to Bloomberg's Stephen Cowell and Jack Sidders. So plenty of challenges then facing the next government. But first, of course, we have to get over the general election. We've been watching the performance of the smaller parties too. Nigel Farage's Reform UK has been creeping up in the polls, benefiting from the drop in support for the Conservatives. The Liberal Democrats and the Greens are also hoping to make gains. We'll have full coverage and analysis of the election results on the 5th of July here on Bloomberg Radio. I'm Caroline Hepker here in London. You can catch us every weekday morning for Bloomberg Daybreak Europe beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. John.
All right, thanks, Caroline. And just ahead on Bloomberg Daybreak Weekend, we look ahead to Hong Kong's handover anniversary to China and examine its current relationship with China. I'm John Tucker, and this is Bloomberg. I'm John Tucker in New York with your global look ahead of the top stories for investors in the coming week. This coming July 1st marks the 27th year since the handover of Hong Kong to China from British colonial rule. Let's get to Bloomberg Daybreak Asia co-hosts Brian Curtis and Doug Krisner to talk about the changes the city has been through.
John, the anniversary of the handover puts Hong Kong back in the global spotlight. Establishment Day, as it's called here, means different things to different people.
Hong Kong's chief executive John Lee says the anniversary will be a day filled with joy. Now, that will be the case for many loyalists who see the return of Hong Kong as a key moment in China's rise.
But for many others, it will be a day of frustration. Since the handover itself, in addition to celebration, July 1st had been a day of peaceful protest for promises not yet kept. It was a day when hundreds of thousands of people would march from Victoria Park to Central, calling for more democracy. But all that changed in 2020 when Beijing imposed a national security law. Since then, no large protests have been allowed.
Meantime, Hong Kong has also faced challenges on the economic front, the pandemic, the protest, and U.S.-China tensions, all weakening the economy. The property and stock markets have seen aggressive declines. As an example, the Hang Seng is down 36% over the past 5 years, and the region has seen an exodus of local residents and foreign professionals.
So joining us now for some insights on where Hong Kong is heading is Jenny Marsh, Bloomberg team leader for Greater China EcoGov, and Alan Wong, Bloomberg China EcoGov editor. So Jenny, let's start with you. Let's examine really what's changed here since the handover. Freedom of the press, the rule of law, the independence of the judiciary, and political opposition all have been severely diminished. And a recent example is Lord Sumption, one of the UK judges who resigned from the Court of Final Appeal. He said the rule of law here has been, quote, profoundly compromised. So my question to you is, how much has the high degree of autonomy actually been eroded?
As you say, there's been many ways in which, China has made this huge push over the past 4 years to sort of really make sure that it has Hong Kong under control in all the ways that Xi Jinping thinks matter. So, that is sort of wiping out the opposition from the legislature. It's not having this sort of rambunctious kind of free press that we used to have. It's making sure that people like Jimmy Lai, who had long been a thorn in the side of Beijing, are under control. So what you have now, Hong Kong, there's a sort of outside perception, I think, that Hong Kong has become another Chinese city, which I think, on the ground is not what it feels like here. But for sure, there have been huge changes in sort of what you can say here, what you can print, and the way that the political system works. And the result of all of that has been that the Communist Party feels that Hong Kong is now firmly under its control. And for so many years, Hong Kong was given all these freedoms to have the kind of street protests that you laid out that were really kind of a symbol of sort of what made Hong Kong so different from mainland China. And the erasure of that, sort of the result is that in many ways, Hong Kong feels more similar to mainland China. But of course, there are still some really big differences here. And I think, chief among them is the fact that we still have a free internet. And there have been cases that have sort of dipped their toe into testing the limits of that, such as the government's injunction on the Glory to Hong Kong song. But overall, the internet here is still free. There's still much greater freedom of speech here than in mainland China. And on the courts, there's still the common law system here. It's a very different legal system to the one in mainland China. And while, we are seeing sort of the foreign judges backing off, they're pulling away from the Court of Final Appeal because they don't feel they can sort of uphold this system where the national security cases are going through the courts. It is still a very different legal system to mainland China. So, I think overall, we've seen the liberal freedoms that we had here, the way you could push for democracy, all that is over. It's a new era for Hong Kong. So, essentially, Xi Jinping has it under his control. But now the question really is, can Hong Kong continue to walk that fine line? Where does it end? Is this the Hong Kong that Xi Jinping wants, or is there more to come?
So the rights that you're describing there have been pretty much enshrined in the mini constitution, the basic law. But now, as I understand it, the national security law from China is above where the basic law had been. So, Alan, is there a case to be made that in some way Beijing is violating the terms of the handover?
Some foreign governments have definitely made that case, saying that what China did with Hong Kong by imposing the national security law is a violation of the Sino-British joint declaration that saw Hong Kong return to Chinese rule back in 1997. China would claim that it has every right to protect its national security. But I think for observers, what's important is that when they look at Hong Kong and see the headlines, they're seeing that the July 1st march has been curbed, and the annual June 4th commemoration of the Tiananmen Square massacre was also curbed. So those events were only allowed in Hong Kong, across China, and they for a long time was seen as a symbol of Hong Kong's freedoms, and that distinguish Hong Kong from the rest of China. So that is now gone, and so if you look at why they created this one country, two systems framework for Hong Kong's return to Chinese rule, those distinctions are being erased, and it's no wonder that people question if China's actions amount to a violation of the spirit, if not the letter of the initial design.
The protesters were calling for that which was promised, as I mentioned earlier. And you wonder whether or not, what was the catalyst for China feeling as though that they had gone too far? And I'm also curious, Alan, whether or not you think that the U.S. and the U.K. and others actually hurt the political aspirations of Hong Kong protesters by being so supportive. I know that sounds funny, but some would make that claim.
I think it's a legitimate claim, and some, a question that I'm sure historians will ask themselves going forward. The China and the Hong Kong authorities, they have now branded the 2019 protests as some sort of a color revolution, which generally means that people trying to topple the Communist Party. That would be a crime, in many places. But I mean, any reporter in Hong Kong covering those events could tell you that, people weren't out there. Most people weren't out there to try to overthrow the government. Most of them were responding to what they saw as police abuse in their enforcement action against protesters, as well as a demand for greater freedoms in electing their own leaders and lawmakers.
Let's talk a little bit about the demographic shift. We have been alluding to the fact that there has been a bit of a brain drain happening, while at the same time, from what I am understanding, the World Bank is saying that Hong Kong has the world's lowest fertility rate, and nearly 30% of the population will be 65 or above by 2040. So, Jenny, is there kind of a crisis happening when you look at the demographics?
Absolutely. It's not just Hong Kong. Hong Kong's sort of trend of this aging population is in line with what we're seeing in other parts of Asia. Japan, South Korea, and increasingly China having similar problems. But in Hong Kong, it is acute. And it hasn't been helped by the political problems of the past few years. There's been a big sort of exodus of talent overseas. The UK has this visa program now, which has seen, tens of thousands of Hong Kongers leave. Most of those are young people. Exactly the kind of people, from an economic point of view that you'd want to keep in the city. That's an issue for the Hong Kong government. At the same time, in terms of sort of overall population, we did see this big exodus during COVID and in the wake of the protests, and when the UK and other nations such as Canada opened up visa programs. The government says now that the population actually has sort of replenished back to sort of the figures we were at pre-COVID. But I think what you have seen is a demographic shift. And so where we did sort of, lose people from mainland China have come in and sort of replaced those parts of the population. It's hard to know exactly how many foreigners have left. We don't have the latest census figures on that, which would tell us. But I think just anecdotally, when you look at some of the schools and like the private members clubs, it feels like those institutions which rely on expats are they're reporting fewer foreigners in their ranks.
I think many people expect a lot of mainlanders to be coming here and perhaps to help on that front, to provide younger people here. You need only walk around Central and get in the elevators, and it seems like mostly what you hear is Mandarin these days. I was told a long time ago, right at the handover, that Hong Kong was on its way to becoming an important regional city in China, but it would lose its status as a regional powerhouse and indeed a global powerhouse. Is that where we're heading, Jenny, or can it be turned around?
I'm not sure that is where it's heading. I think because people maybe expected China to sort of liberalize more than it has done, but that doesn't seem to be the way that China is trending, particularly, as Xi Jinping sort of gets into sort of more of a confrontation with the US. So, Hong Kong is a very important conduit of flow of money between the mainland and the rest of the world. The biggest problem for Hong Kong, I think, is that China's own economy is slowing down. So there's less of that money flowing. And, that is really one of the biggest drags for Hong Kong right now. And then in terms of, the regional powerhouse thing, I think it's the same point. Once there's more money to be made in China again, I think Hong Kong will flourish. The other problem Hong Kong has, though, is that its own geopolitical ties with Western countries are also quite strained. And I think while that wouldn't stop people from living here and doing business, what they worry about is the unpredictability. Are there further sort of, will there be more sanctions on leaders here? Will that create a backlash from Hong Kong? Will Hong Kong lose more of its special status around the world? That sort of adds instability, which I think is a risk to the city's future as a financial hub.
No doubt about that. I mean, we know Hong Kong for that reason, being a kind of a gateway into China. But is there a move, Alan, underway to try to diversify the economy in any way, away from financial services, away from banking?
Hong Kong is certainly trying to diversify. For the longest time, it's always put all its eggs in one basket, which is China. But in its effort to diversify, it's still trying to position itself as the gateway between China and the rest of the world. But where it's making more efforts now is in the Middle East, in Southeast Asia and South Asia. And I believe the chief executive just mentioned that the government will tap Latin America as well in trying to pitch Hong Kong as a destination for the investment and access to the Chinese market. In other areas, for example, tourism, Hong Kong is now realizing that it can't count on Chinese tourists forever and is trying to attract tourists from highest spending countries, for example, Japan. So this is relatively new because Chinese tourism, when the Chinese economy was performing well and growing rapidly, they were big spenders in Hong Kong. They represent the biggest slice of the Hong Kong tourism pie. But now with the slowdown in the Chinese economy and the uncertain future with its economic growth, Hong Kong officials are thinking about alternative sources of tourism, which make up a sizable part of the economy and the local labor markets.
Alan, thank you so much for joining us. Alan Wong, Bloomberg China EcoGov editor, and Jenny Marsh, Bloomberg team leader for Greater China EcoGov, with us here on this look at Hong Kong on Establishment Day as it approaches in the coming week. I'm Brian Curtis, along with Doug Krisner. You can catch us every weekday here for Bloomberg Daybreak Asia, beginning at 8 a.m. in Hong Kong and 8 p.m. on Wall Street. John?
All right, thanks, Brian and Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm John Tucker. Stay with us. Top stories, global business headlines are coming up right now.